episode 5 of the Wealth Amplifier podcast from Amplius Wealth Advisors. I'm Matt Liebman. I'm joined today by Aaron Marks and Patrick Swift for our 5th episode of the podcast. As a reminder, before we dive in, nothing we say today should be construed as investment, legal, or tax advice. You should seek the counsel of your own investment, legal, and tax advisors before making any decisions in those areas. So for the first episode of 2023, we want to focus on forecasting and predictions because that's what people do at the beginning and end of years. So before we dive into that, let's just go over what happened in our capital markets in 2022, just a couple headlines. For the United States stock market, it was the worst performing year since the global financial crisis of 2008. For bonds, it was the worst performing year since the actual bond indices started, and likely the worst year since the 1800s. And for a 60-40, that's 60% stocks, 40% bonds, sort of a typical institutional and retail portfolio that people track, it was the worst year since the 1930s, since the Great Depression. So with that as a backdrop, a lot of people put out forecasts at the beginning of last year. So, Pat, why don't you tell us how the prevailing consensus and the geniuses out there did last year? And then this year, not to be outdone, we'll throw some of our own predictions out there just to be part of the fun here.
Okay. All right. I love it. I think if you look at last year's predictions, it was a perfect year for us to sit here with hindsight and make fun of predictions, which is at least to our credit, what we often talk or speak to is predictions are mostly meaningless in the short term. 2022 was a really good example of that. 2021 was probably also, but almost every year they look a little foolish, but it's funnier, or at least a little different when they all are negative. So I'll give one example, and I'll let us this can be sort of a roundtable discussion. But there was an article I had read January, I think it was February, from Bloomberg of last year that I couldn't find today. They do a good job hiding this stuff now in hindsight. But it was talking about Bitcoin, I think, had started to dip maybe just ever so slightly from, I think, like its all-time highs in the $60,000 US range. And this genius, they interviewed all these geniuses in the crypto game who maybe they're all jobless at this point. But anyway, they had mentioned that the support level for Bitcoin, the sort of buying opportunity, if you will, would be like 41,000. And the quote from the article from this guy was like, if Bitcoin goes below 41,000, like you got to just like rush in there. And
how'd that work out?
Right. How did that work out? A Bitcoin is today, around 17,000 as of like January 2023, something like that. Down, I guess, since January 1st of last year, about 63%. So you would have had a lot more pain. You would have lost about 100% almost from those levels. So I think that's just one headline that I'd point to. But there were a lot of them out there. So Aaron, I don't know if you want to jump in on some other stuff there too.
There are a lot of specifics that we'll hit, but let me ask you this. Why do you think we do it? Do you think it's for no other better ideas at the start of a year?
So I got a better answer to this then. So there is almost unlimited upside to making a prediction that turns out right, especially in our industry. So if you make a prediction and it catches the attention of any PR firm, any media outlet, anything, catches fire, guess what? You can make a career off of that. Your upside is like, again, it's almost unlimited. Your downside is like zero. Nobody's like, oh, remember that idiot who said Bitcoin was going, whatever. Like no one ever goes back and was like, oh, you were wrong about that. Like they don't care. We just move on to the next thing. So that's what it is. That's totally.
And even in the moment, you make the prediction. You don't know in that moment it's going to be right or wrong. But if you're in a sales position trying to raise money for your fund, your advisory firm, whatever it happens to be, hindsight comes later. But you're going to find somebody that agrees with you at that moment. Once they're bought in, they agree with you, they're a partner of yours, market plays out and the bet went wrong, you could always justify it and say, hey, well, here's what went wrong, here's what our thinking was, but next year, really, we think we're narrowing in and hitting the nail on the head.
Yeah, and I think on that, to Pat's point also, I think a lot of the incentive is just to be as noteworthy and outlandish as possible in predictions. Because I'll point this out: like, we get plenty of stuff wrong, so I don't want anybody listening to take this as a lack of humility. We know we get plenty wrong. We're humans too. But I do know that, like, one thing we were saying in the back half of last year that proved to be correct, and we had some speaking engagements and such, was this idea that after the first 6 months of the year, we'd entered this period of volatile mediocrity where the markets wouldn't go very far, but would sort of be good, bad, good one quarter, bad one quarter, et cetera. For the back half of the year, that proved to be right. But it's a really boring prediction. Like, no one's catching on. Like, remember those guys that said things would go sideways? They were right. Like, it doesn't work out all that well. So I think there is an incentive to just say more, let's say, attention grabbing things.
So how about not Cathie Wood and ARK coming from them, but more the industry and individuals loving that world, FANG stocks, high growth, high tech. It's the wave of the future. Look, you have this fear of missing out and you don't want to miss that boat, but everyone was calling for just exponential growth. And obviously that went the other way. But do you think that it gets overdone and people start to ignore good ideas that were good ideas and had just, there were rough circumstances out there? Like, I personally don't think whether you like Cathie Wood's strategies or not, or think she's a genius or not, I think you can't write off growth and innovation for the future. But do you think people do that too quickly?
Yeah, I think yes is the short answer. I think people get too emotionally attached to a theme, and then when it disappoints them, they want nothing to do with that theme forever. So I don't know if that time's now. To your point, I'm not predicting the comeback of Cathie Wood. But if you look at investments like that, they tend to be a roller coaster, but roller coasters don't go straight up or straight down. There'll be good years again for those themes. In fact, somebody agrees with what you were saying, because I think she was in net inflows last year, despite all the money, all the performance going down.
Yeah, I think that can be a detractor too sometimes, where we've talked about it, probably even on this podcast, but with clients and just internally, where it's almost worse for you potentially in the future by getting a prediction right or having an outcome in your favor that you attribute to some genius or some incredible foresight, when probably it was luck, or it was 70% luck, because that's going to make you jaded towards what like future outcomes are going to be because of that experience.
And you rely on that. Hey, I'm going to get it right again.
Yeah, exactly. And I think maybe here it's a good defensive tact for us. But we brought on new clients last year, right? And their portfolios with us, although we're doing all kinds of other stuff for them, their portfolios don't look great necessarily unless they invested like October 1st of last year, right? So, and I try to turn that, even though again it's us being somewhat defensive, I turn that into a positive, because I try to tell them, like, look, if the market just went straight up from the day you invested with us, it's not my fault. Like, I didn't do that. I wasn't like some wizard and all of a sudden your strategy changed. But you're going to be jaded by that potentially and reliant that I'm some kind of genius. And that may set you up for failure in the future. I'd almost rather you stick with us and start with us during troubling markets to see all the other stuff we're doing for you, so that you're sort of aware of those facts. So again, I don't know, like, it's maybe a cop out for us in some cases, but I think it's pretty true. I think it's actually better for people's psyche longer term when you deal with that.
So what were some other ones you guys remember from last year before we dive into some predictions for this year? Other noteworthy ones that maybe didn't work out so well?
Well, so just following along the ARK and high growth, it was values dead, investing growth. And I think looking at the numbers, I think value equities outperformed large cap growth by about 20% last year.
Right. And Aaron, you and I think we've spoken about this on past podcast episodes. November of 21, we're at a great conference. And again, I'm not disparaging by any means the firm that put it on. It's one of my favorite firms on Wall Street, and it was a great conference. However, every guest was just talking about growth, 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 growth. You might have thought value didn't exist at this conference that we were at. And to your point, what happens promptly thereafter? Value outperforms growth by the most in years. Well, just as a caveat, we were at that conference again this year. What was the theme that everybody was pounding this year that maybe people should be a little wary of?
I asked that question going in. What do we have to listen for that we need to be aware? Like alternative investments. You hear it from everywhere, and that's a category. It's hard to.
It's a bit of a conundrum though, because I think there are opportunities there, right? Like we're sitting in a marketplace where asset classes broadly are much cheaper than they were a year ago, which means investment opportunities are more attractive from a price standpoint. But if you use that contrarian mentality of, hey, whatever the hot trending topic is in the industry, and you shy away from that, oftentimes that spells positive results. So we're kind of like, it's a bit of a conundrum right now, I think, for us, because we're like, the alternative investment universe makes a lot of sense right now than it did a year or two ago, especially for early stage venture capital, things like that. But if everybody's talking about it, like, what are we missing? Like, where's the contrarian here? So
the reason that is so difficult. Look, we're going to fast forward a year from now and look back at this one, and we're going to say what a bunch of bozos we were. How did we not see this coming? Because that's just predictions. That's how it works. But the alternative investments theme, it's hard because you can't say that doesn't work, because that being alternative investments could be real estate, private equity, venture, debt, a structured note, a market neutral fund, and real estate could do very differently than one of those other categories. Right. So it's hard saying equities are out.
Which is why
let me flip it around then and play contrarian. But so I agree with everything you said. So maybe the contrarian theme that we should pick up from that is that the traditional investments are not dead. That the stock and bond generic boring investments that were great for 40 years but had an awful year last year, maybe now is not the time to ditch them, even if you add alternatives as well.
That's a good point. And I think to your last question, Matt, of what other predictions went wrong, it's hard to remember all the specific ones, especially when these media companies seem to scrub their databases, so I can't find anything. But there's been a pervasive, this happens like in any landscape that I've been a part of so far in my career. You hear this, the new normal, we're in the new normal. This is the new normal, right? You heard that last year. Growth is the new normal. Zero interest rates are the new normal. Well, guess what? 1 year later, that's literally the opposite. And I think now you're hearing the same thing. New normal. We're going to be higher interest rates for longer, and the Fed's going to stick it to inflation for longer. And you hear all these, like, guess what? Maybe not is really at the end of the day what the truth is. And I think that's why you have averages, right? You have long-term averages because there are excesses and new normals every other year. And then you have like a totally, disparity in asset classes and markets. And then that's where you have like average returns that end up working longer term.
Right. If you go back to fundamentals, and for everyone that's claiming 60-40, 60% stock, 40% bond portfolio is dead, you got to think, well, wasn't the 60-40 sort of dead in the last cycle because the 40 being bonds gave you nothing in terms of income and yield? But now everyone knows rates have gone up. So why are we all just casting bonds aside now? I don't think we are, but you hear that a lot. 60-40 is dead. But to your point, Matt, maybe it's not. Maybe the old vanilla boring the way it was before, that is now the theme to, hitch upon.
And, totally agree with both you. And that, Pat, some of what you were describing is the sort of Sam Liebman investment philosophy of mean reversion to the mean. Nothing goes in the same direction forever that we do, certainly has a key part of our analysis here. But I think at this point, it's time we should stick our own necks out there and go on the record with some predictions, see how well we do. And this is just, again, I know we did our disclosures at the top, but this is just for fun. This is not how we are designing all of our portfolios to the penny right now, but just some general capital markets and economic predictions that we may have for 2023, just so we can check ourselves a year from now.
So you guys don't want to dance on any more graves from recent years?
It's too easy when the stock market and bond market all just goes straight down.
I'm only joking.
No, and I was looking for some that we could highlight where someone nailed something and got it right, and it was like, and again, to your point, the media does scrub a lot of old stuff. I couldn't find many though. For the last year was a pretty ugly year. So.
Here's one that's super boring, and then we should just go right into predictions and stuff. At least from what we were hearing from a lot of the people we get research and insights from, there's been the theme of like someday, some year, international stock markets are going to outperform the U.S. at some point. And guess what? I guess you correct me if I'm wrong here, Matt. Last year they did ever so slightly versus the S&P 500, like the S&P 500 U.S. index versus your broad international non-U.S. index. Roughly outperformed the United States over the course of the year. But guess what? No one cares because they were both down like more than 12%.
Right. They can't catch a break over there.
Right. They can't catch a break, but technically they had their
it happened.
Their year in the sun was minus 14 or so. So
all right. So I'm gonna start asking the tough ones. The things that everybody's talking about, top of the list, the Fed and interest rates. Do they keep rising? Do they rise and stop and stay for forever? Do they pivot and start cutting? How fast? How long? What do you think?
All right, I'll go first on this one. They are almost finished hiking. They're not done yet, but I think we do get one or two more hikes. But unlike a lot of thoughts that think they're going to turn and pivot and start cutting, I don't think they start cutting till at least 2024. I think we stay at whatever their peak is, wherever they stop. I think we stay there for a little bit longer than consensus thinks.
Mr. Swift?
You're making me squirm. This is like my least favorite thing in the whole job. I hate making predictions. It's hard to disagree with that. Matt is always such a smart, middle of the road guy. I would, to add some fun to it, and I'm not personally that far off this, but I think it's possible you see a rate cut later this year. I think it would probably be the result of fast forward 6 to 9 months and we have poor economic conditions, way worse. We find right here, because there is a theme I think people have talked about that somehow the Fed hasn't broken anything major in the economy despite their insanely rapid rate hike schedule we've seen over the last year. And maybe it just hasn't happened yet. So maybe they do break something and we have labor market weakness far beyond, and they have to change their mandate again, or inflation is not sort of coming down as they see it. And we do have sort of a prolonged economic, or at least just sort of more deteriorating economic conditions. I mean, in that case, you could see a rate cut and some normalized conditions. So we'll see. I think house prices will be a big factor in that. So
all right. So I don't have any fundamentals to support what I'm going to say.
We're all
the better.
Right. If you recall, I don't know if it was our first or second. It just echoes sort of the theme of this conversation is nobody knows anything. Yeah. And when everybody's saying one thing, the opposite's probably true. And general consensus is rates stay high. They have a ceiling, was it 5.25? They're shooting for. Maybe there's a rate cut. Not one person is saying rates just keep going up. And I don't really think that's going to happen, but maybe it is because everyone's saying the opposite. So I'm going to go in the opposite camp and say that inflation, okay, maybe it's dipping a little bit right now, but it starts to run rampant again. And, we see inflation come down a little bit and stock market goes wild to the upside. And then the Fed says, hey, look, we're pedal to the metal. Let's keep going. So I'm going to say they definitely don't cut and potentially even higher than expected.
All right. So I'm with you on 50% of that. And I think it's a good prediction.
So we hit all three potential outcomes.
That's predicting in a nutshell, right? Just cover your bases.
Yeah.
Here, I'll give you one since Pat, I think correctly accused me of often being middle of the road. This happens to be a middle of the road prediction I have for next year. Stocks, we'll say the U.S. stock market, just to keep it simple there. neither make new lows on this bear market. So we neither go below the lows of last year, nor do we make all-time highs, but we say stuck in this range. So I think the S&P all-time high was about 4,800, if I'm not mistaken, and maybe hit a low of about 3,500 last year, give or take. I think we stay in that range this year, that we don't break out to the upside or the downside.
So you're saying that's your outlandish call, Matt?
This is outlandish as I get, Pat.
So I think staying in the theme of going against the general consensus. We were talking about this over the weekend, as we always chat on these topics. What's the market saying? What do we say? What's the feel out there? General consensus, I believe, what we hear the most right now is the first half of this year is going to have a lot of uncertainty. And then second half of the year, all right, we're off to the races again. But you really, if you think about it, I could see it going the other way, because inflation is starting, as we see, to come down a little bit. And every time we get those readings, market shoots higher. So if that continues to happen, meaning the interest rates that have gone higher are starting to work, we're going to keep on cheering and cheering and cheering, and market's going to keep taking off to a point where, okay, we are slowing. Inflation is coming down. Wait a second. Is the recession real? Like, we always saw the recession potentially coming, but once it's 5 feet away from you, that then can set the alarms off and the fear bells. And I think then that second half of the year ends up being a tougher part. And maybe the first year, we've got some smooth sailing to the upside.
It's a good.
All right, Pat, it's your turn. We got to hear one.
All right. Well, actually, can I ask you guys a question first, and then I'll give you some.
Sure.
So here's a more economic one, because I think this is related to everything, obviously. But do you think that there's been some headlines for the last few months, big tech companies and to some extent some of the big banks are making pretty significant layoffs in their labor forces, and these are enormous companies in our economy, so they get a lot of the press. Do you think that is a fair view of the average U.S. company right now? They're looking to lay off their staff to some extent or make cuts, or do you think it's concentrated in the sectors that have gotten hit the hardest over the last year or so? So therefore, they're sort of should be laying some people off.
Good question. I mean, the service industries have been shorthanded for a long time, and you're starting to see restaurants becoming full staffed again. But you hear all these troubles of being able to hire. So it's a good point. I guess I then do lean to the side it's concentrated within tech, which is a huge part of what you see. And you see Apple and Amazon; they're the big drivers of the S&P 500. But as to how it really relates to the economy, maybe it is the other way. Maybe the layoffs don't come in full force and hiring stays strong.
Yeah, I think, not to sound like a politician running for office, but small businesses are the backbone of our economy, but they kind of are. And we talk to small business owners all day long, and anecdotally, they're hiring. If anything, they're struggling, like Aaron said, to find people to hire. So I think big businesses may lay off. And I do think this idea that 5 tech companies were just going to own the entire economy and the whole stock market has probably taken a hit in the last year. And that's probably a healthy thing, that we have a more balanced economy. But I think that's part of, that might give some credence to Aaron's prediction about the Fed continuing to raise rates. I don't think the job market's is going to get particularly weak anytime soon.
It's a fair point. All right, so
Pat, you're on the spot. We need one.
So I'll give you a stock market prediction. I'm going to say, so I'll give a stat and then I'll give a prediction. We talked about this earlier this week. I think it's just a cool stat in general. We talk to people are somewhat familiar with, if you stay invested in stocks, call it more than 10 years, 20 years, long time horizon, you typically end up with a 10% annual average return based on what historical returns have been for the last 90 some odd years. The stat is, in only 1 or 2 of those years total, I forget the exact number of years, did the actual S&P 500 index finish with a 10% annual return, 10% return. Meaning most of the time, in all the other 80 some odd years, you ended up with big lows or big highs or somewhere in between, or sort of small incremental moves. I'm going to go on record. I'm going to say S&P 500, large U.S. stocks in the U.S. finish 20 to 25% higher than we start the year.
Wow.
I thought you were going to say it's going to be 10 because
I thought you were going to pull that prediction. This is the year we're doing 10.
We're going, it's going to be big up year. But I don't think, I'll give you more specific. I don't think it's going to be a quick return of growth stocks that leads us there. I think it's a year to own all stocks, all cap, sort of large, medium, and small cap stocks, both value and growth. Value probably does slightly better. And I think international probably does well too. I don't have a specific prediction there, but I think it's a good year to own stocks broadly.
All right.
So I'll give you one last question for me. You guys could have other predictions, but because of the crypto junkies that we are, being facetious, what is more likely? And let's just go with Bitcoin. 1,000 or 100,000?
You mean like which one does it hit first?
Which one does it hit first? If it had to hit one, where's it going?
Oh, I thought it was going to be easy. Will it hit either this year? And I'll say no, and I'll be done. Wow,
that's the end of it or it's the beginning? What do you say?
That's a good question.
As you see, listeners, we did not discuss all of these. But we're putting each other on the spot.
Wow. Does it hit one? And Pat, you said it's what, about 17,000? No, I don't even follow it that
think
year.
So. Yeah.
I'm going to contradict myself here. I'm going to, and anybody, and when I say anybody, roughly like 5 people who saw me on a panel in Houston recently heard me say, I'm out on crypto. I was never in, but I'm definitely out. That said, if I had to pick between Aaron's 2 choices, I think I'd pick 100.
1,000, you mean?
No, 100,000.
Oh, 100,000. Oh, so you are going high. Okay.
Going up.
And by no means am I recommending anybody buy it. I'm not bullish. I'm not advocating it. Every disclosure you can add, I don't own a penny of it. But if I had to pick between those two, I guess long term I'd be more likely to be long than short.
And I like it. So I'll give my thought, but I think it's important for us to showcase a little humility here. It's easy for 3 guys who probably were never crypto bulls to now be like, oh man, like good thing we were never crypto bulls. Like this is the same stuff that we say to other people about things that they're biased against. So again, just kind of pointing out our own humility here a little bit. I think my real answer to the question is I don't think it hits either. Ever. And I think it's more likely to go to 1,000 than 100.
Who would have guessed that Pat would be on that side and I would be on the other on crypto?
Yeah, I wouldn't have. And look, I'll caveat that for anybody who is a friend of mine or a client of mine who loves crypto and they're disappointed by my answer. I think the cryptocurrency and space has room to recover and figure itself out. But I think maybe there will be some unknown development that sort of bypasses Bitcoin. That'll be my saving grace there.
All right, Aaron, answer your own question.
Well, I'm just trying to do the math here. I think I'd have to say 100,000 because for it to go from, we keep, again, this is how little we're into Bitcoin. It's at 17,000 now, roughly.
17,500, yeah.
So it's got to go down 95% to get to 1,000, and it's got to go up a whole lot less. How many times I go, it's going to 100,000 quicker than it goes to, or if it had to hit 1. Just because it's a little out of favor. Here's my reason. Nobody's calling us to buy it. When everyone's calling us to buy it, that's a sign to me that it's a time to move away from whatever that investment is. It's out of favor. No one's talking about it. No one's calling to say, can I buy it? Probably the time to buy it.
I would agree with that mentality broadly, yeah.
All right. Well, we've gone a little over today, so before we break, why don't we all, share something, a book, a TV show, something you're watching or following these days to start the new year.
Matt, what do you have?
So I was with a few friends on Saturday, and I was introduced to the show. I started it this week. It's called Kaleidoscope on Netflix.
That's what was going to be mine.
Okay, so I don't know if you know this fact or if the listeners know this fact, but for each person's Netflix account, when they sign in and click on Kaleidoscope, all the show names, they're named after colors. They're like episode red, episode green, episode yellow. They're all in different orders. So the finale, I think, is episode white regardless. It's like this heist episode. That's what everything's building towards. But every person's like the three of our Netflix accounts all would potentially
You're saying my first one was green, and I think my second was yellow. Yours was not?
Correct. I think
Wow.
Well, let me ask you a question. Hold on a second. Are you saying they're in a different order, or the title of that first episode is different?
No. The episodes are in different orders for each person's account.
Get out of here. So the episode I watched first is not your first episode.
That's right.
crazy.
Yeah.
I've never heard of that.
Yeah.
Oh my gosh.
No, it was like blew my mind. I was comparing on my phone with someone else at a table, and we confirmed it. I was like, oh my God, cool.
Okay. I like
That's
that.
like a mindset, because I'm so like not the creative type. It's like a mind, whoever could create that, it just blows my mind. Like,
Yeah, very impressive.
creating a show to begin with, but then having like different orders and somehow that's like outside of my realm of understanding.
That is really interesting. So I've watched 2 episodes, and I'm thinking to myself, if you flip flop them, would I have known what I knew going into that second? And if I watched the first one, how would I have known that person's related to that person? I don't want to give it away here.
I do think, and I'm not 100% sure, but what the person told me is like there's sets, like I think like 2 episodes kind of go together. Like green and yellow are supposed to be sequential, but like red and blue are also sequential. So it would have to, you know what I mean? But they mix and match the sets. That's what I heard at least.
Wow. Well, I'll go way different from you guys, but I'm intrigued by that. So I went to London over my kids' winter break. The 4 of us went to London for a week, which was awesome. And one of the highlights of the trip was going to the Churchill War Rooms and learning about the sort of the British strategy during World War II and sort of effectively the command center, if you will. So I've been reading this book by the old, I think he's on CNN now, used to be Fox News, Chris Wallace, wrote a book a year or 2 ago called Countdown to 1945. And it's basically all about, give or take, the 180 days from the time FDR dies and Truman becomes president to the time that they decide to drop the bomb. And it's been really interesting. And then I guess on a more contemporary note, been watching all of the Harry Meghan stuff with my wife and daughter since we got back from London. We're all in. So we watched the documentary, the 60 Minutes, the Netflix, you name it.
I don't know a thing about any of that, so I'll have to learn from you, I guess. And mine is because Pat, you mentioned Kaleidoscope. I go back. I like all of us. I'm sure we go in phases. You're binging a show and then you're just watching fluff for a while. But it was over winter break that I was always a very big Seinfeld fan, and it's really not. You don't see it on reruns too much now. It's always The Office, which I really enjoy. And if I'm ever not watching anything, I'll flip onto The Office. I always get a kick out of it, but some episodes are not my favorite. Anyway, for the month of December, they were putting Seinfeld for like 2 nights, 3 nights a week, from 8 to 10 p.m. back to back to back. It is unbelievable how good that show is. And especially when you haven't, I know every line, every episode, but when you haven't watched it for a while, it just sustains. And like MASH, I know I was still on. Is it going to be like that? Like Seinfeld is on forever, but does it only still play with a certain generation as that generation gets older, or do younger generations attach themselves to Seinfeld as well? It's just an amazing show that I don't know if it'll ever stop, but at least for me, it won't.
So you triggered final question: Seinfeld or Curb? Which do you prefer?
I can watch 10 Seinfelds in a row. I love Curb Enthusiasm. But after watching 2 episodes, I've got to turn it off, and I cannot handle Larry David anymore, even though I love him. 2 episodes is about enough for me. So I guess I'll go Seinfeld.
That's a good question and answer. I think I'd go Curb. You're right there, Aaron. Like you can watch Seinfeld more consistently and not get sick of it or like cringed by it. Curb, I think, is like funnier punchlines, more entertaining at this point, but. So I'll go Curb, but I see your point. I see your rationale.
I gotta go Curb. I just think I think it's just like on a raw basis just funnier, and B, for anybody listening that knows our senior colleague, Ed Jower, something about Larry David in that show just reminds me of Ed. So it always makes me laugh even more thinking of Ed in those situations.
Good question. Good final question.
All right, with that, we're going to get going. Thanks for tuning in. We have a couple episodes coming up soon with some special guests, and happy New Year. Happy 2023.
That's a Larry David thing right there. You went a little too long on saying Happy New Year.
That was the 15th. It's the 7th.
Yeah. Well, depending on when we post this, it might be really late. I don't know.
Oh, this is
That's all right.
Dating ourselves. All right, everybody. Thank you very much.
Thanks, guys.